we would love to talk today about investor mindsets and what can be your investor mindset in 2026. What is up for an average investor to look at?
When you invest, but you start thinking with a mindset of owner-occupier, that how is the appeal for this property for somebody who wants to live in?
If you have $900,000 to spend, people often talk about per spend.
Yeah.
But that $900,000 can be invested somewhere else and you can make great money out of it.
Welcome to the Property Portfolio Podcast, where property, finance and investing are broken down into real conversations, which have benefited thousands over the years. The show is hosted by leading industry experts who bring different strategies to the table. Parag Dixit, Chief Strategist of Infinity Financials and Prop Wealth, has more than 20 years in the financial industry and is consistently ranked among Australia's top 10 mortgage brokers. Mudit Director at Infinity Financials, has 2 decades of experience and over 200 5-star client reviews. He's known for helping clients build strong property portfolios. Julius, co-founder of Prop Wealth, has spent more than 15 years in real estate domain. He is a lead data researcher and has helped hundreds of people create wealth through property investment. Subscribe to the channel and get regular updates on what's happening in the property market.
The information in this podcast is of a general nature and does not constitute financial or legal advice. It has been prepared without taking into account your personal objectives or financial situation. Individuals must not rely on this information to make financial or investment decisions. You should seek independent professional advice before acting on any investment decisions.
Hi guys, how are you? Evening?
Good, Parag, how are you?
Going really well.
Yeah.
How's everything?
Going well, yeah. It's been a good week. Lots of stuff happened. Lots of things happening in the market.
I know.
Yeah.
And it's just such a changing market. I can't believe about a month ago we were talking we'll have 3 rate cuts, 4 rate cuts in 26 and whatnot. And now we are talking of 2 rate rises, 1 rate rise, and it's going to Feb, it will rise, or maybe in some other month it will rise. So it's such a varying market. It's an amazing thing. It's so surprising how the markets change so fast. It's going to be a very, very different 2026 for all of us, right? And it's going to be a brilliant time for all of us.
Precisely, yeah. And then we could sense that now. So what I could see is this is December, but phone is pretty busy.
Absolutely.
Keep on getting a lot of calls as people are getting ready for the next purchases before the bank changes the policies.
Yeah, lots of changes coming up in 26. I think there's those APRA guidelines which kick in from 1st of February. So that should bring in some kind of a change. There's an interest rate rise looming around, and Fed's cut rate this week in the US, but they're not sure about next year. Unemployment, I don't know where it's going to go in. Inflation, it's going on a different trajectory. So this is a lot going to happen in 2026, and I believe that there will be a bit of a strain on investors, a strain on owner-occupiers, but there will be a lot of value buying and a lot of value opportunities which will be available to people. And there may be chances that we are looking at some great opportunities where we may also be looking at misses in the market. So it'll be very interesting how people pick and choose what they want to invest in, how they are able to really identify where should I go, and that's where the opportunity lies. And how do I don't think so there'll be those gangbuster return suburbs or maybe states coming in suddenly in the next year.
You're absolutely right. So I think last few years there have been different cities, different suburbs which suddenly came and gave windfall gains to investors. It may not happen at the same pace, the way the things are moving like you're saying right now. So 2026 could be a little different. Especially because of the APRA guidelines and the interest rate changes that we're expecting. So the windfall gains, it's a little doubtful. I think that is where it also becomes more important that how to think and what do you do so that you still beat the market. And because it's not going to be that you pick any property anywhere and it's going to just increase in value. So it becomes even more important. What thought process needs to be there? How do you change your mindset so that you invest but you get better than what generally on an average people would be getting. So that mindset.
Investor mindset. That's a fair play. And I think that's what we would love to talk today about investor mindsets and what can be your investor mindset in 2026. what is up for an average investor to look at? Do we continue the same way? Do we keep on doing what we were doing in 25, in 24, in 23, 22, or do we do something different? And is that investor mindset and is that owner-occupied mindset different, or there are mixes? Can we just bring them together, and does that give value to people? All that's going to come in, right?
Precisely, yes. So when we look at only for the investor mindset, precisely when you look at suburb and when you analyze the suburb with a lot of data sets, so we just look at, okay, financials are matching, you still have a lot of demand and supply gap, and then you jump into that suburb and get into the property.
Yeah.
But when you look at the fundamental purchases, then it's much beyond what you look at from the investor's mindset.
Yeah.
So fundamental purchases means we look at, okay, what kind of suburb is that? What is the population type? How are the schools there? Then basically what kind of socioeconomic changes are happening into that particular suburb? And then brings the entire attention about within that population. Yes, that suburb is good now, but when you want to exit from that suburb in next 10 years, next 15 years, whether you will have an owner-occupier appeal for that suburb.
Yeah, so that's a good point, right? So we're talking of investing with an end in mind. Okay, I am going to go into a suburb. I know I'm going to exit out of that suburb in 5, 10, 15, 20 years. So when I exit, how do I find value? So as an, so maybe I should put it like this. As an investor, what do I look at, right? I look at maybe wealth creation. I want to grow my wealth. I want to have my property, if I bought it for say $500,000 today, I want it to go up till say 700, 800, 900,000 or whatever. So I know that there is a wealth creation which happens there. There's a mortgage which has been paid down by my renter, tenant who's staying there. So all that happens. So I grow my wealth in it. I'm also looking at a good amount of capital growth as a consequence of wealth growth. So I will have that capital growth and that gives me wealth. I'm looking at cash flow. Cash flow is critical for me because I want to afford that property. It should be a sustainable property for all these years. I'm looking at all this. I'm looking at getting a leverage out of it. I'm looking at getting equity to buy more properties, or I'm looking at getting equity to buy, maybe go on a holiday, or I'm looking at equity to do things which I want to do. So I'm looking at all of these parameters as an investor. So when I'm talking of being an investor with an end in mind, so I am saying, okay, I want to be an investor, but I also want to be an intelligent investor who doesn't just buy a cookie cutter investment property. I don't buy anything which is just fitting the math. So, okay, this looks good and I just buy it. I also look at, okay, what would I get extra when I do this?
No, absolutely right. So I think when you invest, but you start thinking with a mindset of owner-occupier, that how is the appeal for this property for somebody who wants to live in, the moment you build that perspective into it, it just makes your investment more robust, less risky, and the probability of you getting better growth than an average investment becomes much higher. Because now you're thinking like, if somebody wants to live in this property, how would that person, what are the preferences of that person? How would that person or that family make a decision to live in this versus another property of a choice? So that perspective helps you buy a better property because that gives you a better chance of exit whenever you want to exit.
But do you really think, see, a lot of times we do meet clients all the time. So when you're meeting people all the time, or you meet friends over barbecue, or you meet people over this thing, do you really think that I need to have some kind of a mindset? In the end, an investment is an investment, right? If it's giving me returns, so be it. It gives me returns, correct? But what do you think a mindset brings to me?
Yeah, it's all about mindset, because for an example, if I'm an investor, I'm looking for X number of properties. I'll give you with the example with the recent purchases and then whatever we had done in past, and then I could say, okay, in 2021-22 when we had started purchasing in Perth or Adelaide, two kind of suburb which we were witnessing. So there were suburbs which were extremely popular within the investors, and there are suburbs which had owner-occupier appeal. We started purchasing those properties in between 400 mid 400s. If you look at now, See, every suburb grew because from last 5 years, the entire market was pretty dynamic.
Yeah.
It grew well. But when I look back and see the property prices difference between those suburbs which are purely popular within the investors, and then when the investor was just looking at the investor mindset versus those who bought properties in suburbs where the suburbs had an owner-occupier appeal. So the difference of the prices are very close to $150,000 on an average.
Okay.
That means you did a similar purchases at the similar time, at a similar price guide, but one suburb outperform other. Because
So why will two suburbs have a difference in outperforming others, right? If it's let's say if it's in the same postcode, does it matter?
it does matter sometime, but it depends on where you buy and when you look at the suburb's average price. For an example, two different suburbs versus the same suburb. If you look at the two different suburbs in a similar council, then for an example, if you look at the Blacktown as a council as an example, you have Ponds versus you have Blacktown. Same council,
Two different suburbs.
two different suburbs. So
Going at a different pace.
exactly. So in Blacktown, yes, you see older houses, type of properties are different. Type of population is different, type of schools are different. Versus when you look at the Ponds, type of population is different. The affordability index within the population is different. Affluency is a bit different. So 5-7 years ago or 10 years ago, when you look at the prices between those two suburbs were similar. There is difference of around $50,000-$60,000. If you look back now, then probably the difference is around $400,000-$500,000. So it's just not about the investment perspective, because Ponds is very famous within the owner-occupier also. So those who have invested in Ponds during that time versus those who have invested in Blacktown, they got outperformance.
Okay, so let me ask you this. Okay, so now these are two different suburbs. We understand. Okay, this is suburb A, there is a suburb B, and I found a house in suburb A, and I found a house in suburb B, and in suburb A, and both of them are, let's say, similar prices. But I've understood that this suburb has more owner-occupier appeal. So I'm thinking that because there's a good owner-occupier appeal, so if I'm going to invest here, I will do good. But then in that same suburb, let's say we've taken the example of Ponds in Sydney, right? So we've taken this example. So in Ponds, if I'm saying there is an average growth of that suburb at 5%, that entire suburb is not going to grow at 5% equally, right? So there will be a difference in growth.
Exactly. So within the same suburb, there could be two different prices. So because within a suburb, you have pockets within the suburb, right? Few pockets within the suburb are extremely popular, where the houses are better. You could see the landscape, the entire landscape of the entire streets are different. Where the characteristics of the houses are a bit different. Where there are few houses in the similar suburb where they're facing towards the main road. Then there will be at least $100,000-$200,000 difference in the property prices.
Or it could be the location also. That one of them is closer to some houses are closer to the, let's say, the transport hub, and say there's a train station, or versus something which is farther. I think, Parag, to your point, absolutely right. I think that's the right way to look at it. That if a suburb grows at 5%, that average is an average number, which means some properties would have gone up by 3%, some would have gone up by 7%. So the whole idea of when you start thinking with the lens as an owner-occupier, can you identify those properties that instead of going at an average rate, but you identify properties which are likely to grow at a 7% rather than 3% in the same suburb? So this same comparison can be done at a suburb level or at a larger which city to choose or two different suburbs within a city or property within the same suburb but with a different kind of appeal which is going to... So how do you identify? I think the core question is that how do you identify this 7% versus and not buy something which was probably going to go at 3%, although both are in the same suburb. And that's where this... If you just go as an investor and you say, okay, this suburb, everything is fine, generally 5%, then you may not be able to identify. But the moment you put that lens on, that, okay, if somebody were to live there and buy as in a long term to live, then is this appealing versus that is appealing?
All right. So okay, we've taken this example. So and I remember there was this is a suburb in Victoria, Point Cook, Melbourne. So I think one part of that, which is the school catchment, was extremely popular, and there was another part of that same suburb which is not so popular, and they had a vast difference in prices between them. And that's just because an owner-occupier would think that I want to live in this pocket where my child can go to that school, so I'm willing to pay extra money for it. So if I were to be an early investor and I invest in that area, or I have affordability and I invest in that area, my chances of a capital growth or my chances of doing better in the longer run with the exit in mind are better in that suburb versus in this, and that becomes a positive way of looking at things rather than a positive way of investing in a suburb rather than being on just investing anywhere, right?
Correct, absolutely correct. So, of course, when you're comparing properties like that, there is going to be a delta difference in the price itself.
Yeah.
But then what we're saying is, depending on the budget, depending on what affordability is, when you're comparing, there will always be trade-offs when you're looking at properties. So, the growth, because if you're looking from the lens of an owner-occupier, then you start thinking, then there will be higher chances of more demand for this property. Good times, bad times, but there will be people who will be trying to look at this property from a buying perspective. And then when that demand is there, when the chance of that demand is higher, then you're not going to lose out. So you will make it more.
So okay, I'm an investor. I want to buy an investment property, and now I am putting on not only my investment hat. Okay, I have my investment hat on. I am looking at my maths. I'm looking at my cash flow. I'm looking at my capital growth. I am understanding that I am doing my trade-offs between capital growth and cash flow, and all that bit I've done. Now I am saying, okay, how do I identify between few properties, or this pocket or that pocket, or this area, that area? So I'm saying in the same suburb, if I'm able to pick out properties which are closer to a school, closer to the transport hub, closer to maybe the shopping areas, that's better. That will always give me a much better result versus in the same suburb, but that's a bit further away, and then I have to walk to the train station for about 15 minutes. That property price may not go so well as well, right?
Yeah, precisely. So when you look for a suburb, when you do research, right?
Yeah.
For an example, if you X number of budget, like your budget is $700,000, $800,000.
Yeah.
When you're researching, just don't look at the media hypes and just look at the suburb. When you're looking at the suburb, look at all the fundamentals data as well.
Yeah.
And when you finalize the suburb, then look for the pockets within the suburb where you can have those owner-occupiers appeals as well. That means the type of suburbs which you're selecting.
Yeah.
And when you're coming towards the property, then if that suburb has an opportunity to become a choice suburb for the owner-occupiers, then chances of getting the outperformance in the property is much higher than you go to the different pocket of that suburb. So those amenities, the train
Become
station access is
important.
very important.
And do asset types also? So if you have a different asset type, let's say a townhouse versus a house in a different suburb, so does that also change things?
Yes. So it depends on where you invest and in what market cycle timing you are.
Yeah.
So I can give you my examples. I bought a property in 2018, end of 18. I had a budget of around $800,000, and I was researching about where to invest. I got an option to buy townhouses in Thornley in Sydney.
Yeah.
And then at around $800,000. I was getting good property in Mount Rate for around $45,000.
Yeah.
I opted Thornley because of all these parameters.
Yeah.
If you look at now, the current valuations for the Thornley properties is around 1.9-ish. Mount Rate is sitting at very close to 1.1, 1.2. So when you're looking at those type of comparison,
All right.
then basically we need to look at what kind of suburb you're investing in versus what are the appeals into that suburb. So it's just not about the data. It's about basically whether owner-occupiers are interested, what is the socioeconomy of that suburb.
Yeah.
And then I've got outperformance in my own examples.
Yeah. All right. No, that's a very good take. So you're saying, even though, and it's not bad, townhouses are not bad, but if you bought a townhouse in a suburb, which is a choice suburb, versus even if you bought a house, a bigger house or a different type of house, a good asset house, but if it's not in a choice suburb, you're likely to win in buying the townhouse in that choice area, because when you're looking at it with an owner-occupied lens, you can understand that I am going to have a much better growth when I go there, because that's where an owner-occupier will come when I want to exit, and they will have an emotional purchase, and they will have the, because they look at various factors and they will say, okay, this is where I want to be and this is where I want to go in, right?
Parag, that's such an important point, because in general, we hear a lot from a lot of people that the growth and chances of growth are higher in fully detached houses versus compared to startup properties. That's generally very common, and a lot of people, a lot of people, professionals, everybody talk about it, and people have seen that. So that is there, and that's why it becomes important to understand that it is in general okay, but is it blanket okay? Is that the only parameter that you should be looking at? That's where it changes things. And like Julius, your example is bang on point, that the choice of the suburb itself, because of owner-occupier appeal, can be a parameter which overpowers the type of property. So even a startup property in a choice suburb can outperform. So these are different angles to look at the same thing. You can't just say and make a blanket rule, okay, from now on I'm going to invest only in houses and not in any kind of other properties. That may not be the right strategy.
So that we're bringing a mix into investment of looking at it with different eye as well, so taking the secondary eye as well into this, and that's I've seen that as well. So in fact, when you're talking of securities, when you're talking of assets, I have seen people who are investing in those the same cookie cutter in apartments in anywhere. And versus I know a friend of mine who's just purchased an apartment which has a phenomenal view of the beach in front of him. So phenomenal view of the water. And that apartment is, oh my God, we could give anything for buying that kind of property. So that's where the value can rise, just by having an asset which has, which an owner-occupier can look at it and say, I want to live there.
So absolutely right. I think you used this term a couple of times already, the emotional appeal, right?
Yeah.
So there is always a premium which is attached to the emotional appeal. And if you are a good investor, you would want to cash in on that as well.
Yeah.
And that's what brings this mindset, thinking of a property from that lens, brings in the emotional, and people will pay a premium for that.
And there are those, and this is interesting, because this brings to us very clearly that when I'm going to look at an investment, maths is one bit, but that right mindset is very important. And for getting a right mindset, I need to have the frame of mind. I need to have an input and a knowledge which comes in through me, to do what do I need to do. But the bit is that if my mindset is not right, I may get into an investment which gives me a bit of a return, but then I'll miss out on a larger opportunity of getting above market returns, right, from the thing. Yeah.
Exactly. So I would give an example for this for this one. So for an example, if you have $900,000 to spend, people often talk about per spend.
Yeah.
But that $900,000 can be invested somewhere else and you can make great money out of it. So for an example, $900,000 you spend in Ipswich and you buy a property where the socioeconomy is extremely poor. You buy property where the renters are more than 55%. You buy a property where the affordability is at the toss.
Yeah.
But if you're investing that $900,000 in Canningville, in Perth,
Yeah.
then that suburb has all the potential which you required, like
Yeah.
owner-occupier appeal, that
Yeah.
suburb.
Yeah.
So socioeconomy is 10 out of 10. That suburb's affordability is still below 25 years. Every owner-occupier is dying to get into the Canningville. So that means if I have a $900,000 to spend, rather than just attached to one state because I would just want to get in there, just look at the suburb in another state which has that appeal.
Yeah.
So when you're looking at on an investment, then if you're only looking at investors had, okay, Brisbane is doing good, that's what I have to get into the Brisbane and buy a property. Rather than that, if I'll add that emotional value of, okay, I'll pick up that other state, but Canningville has all the appeals of the owner-occupier, then chances of getting that outperformance is higher. than buying a property in Ipswich.
So that's data analytics for you. So that's a good point. So that's one characteristics which I can pick up if I want to have the right mindset, that I'm just not getting into any investment which comes to me in front of me, says, okay, you will get a 5% return and you will get this and this and this. But I'm saying, okay, I'll add more data analytics into it. I'll get more analysis into it. I'll read more into what's changing there, how population, demand, supply, socioeconomic areas and employment, and what all kind of people live there. So all that bit I bring into the mix and then choose what I want
Correct.
to do.
Absolutely right. And I think, like Julius, like you said, the percentage of rental,
Yeah.
right? So there are some data points which are easy to get, and there's a lot of data which is available. So which are the other data sets? Like renter percentage is one. And of course I can look at what kind of projects there are coming, what kind of transportation is that area coming. These are important factors. What are the other parameters which become a little more important to look at, that whether this area is going to have higher owner-occupier appeal going forward?
It is more towards these socioeconomic changes. Higher the CFI index for the suburb means the CFI index has multiple parameters. It's just not a single index. So it calculates the income. It calculates what kind of population is moving there. It calculates basically what kind of schoolings are there, about the ranks of the schools. Higher the socioeconomic means basically it's more towards the good affluent people. So if the socioeconomic conditions are changing, or if that suburb socioeconomy is much better, with the incomes are much higher, affordability is better. And then in affordability side, when you look at the buying and renting, both the affordabilities, like if you have a buying affordability, and even though if you have good demand and supply gap with good socioeconomy, then yes, because of that buying affordability, more number of owner-occupiers will attract to that area and you'll have a good price growth. Also the renting affordability. Suburb is good, schools are good. I'm not able to afford that area. Still, my income is better, and then because of the renting affordability, the rental prices will go up. So that you're investing in a better suburb where the cash flow will be better, capital growth is better, you have better tenant opportunities, and the type of property which you'll select over there, that also matters. Like you just get into the suburb, and then if you buy a property which is facing towards the main road, then you're killing the growth. Because in that suburb, when you're exiting, or you're buying a product where that suburb is into the Coed Street or on the cul-de-sac with the night street, and then close to the transportation, close to the schools, then that entire asset will be outperforming.
No, in fact, like you rightly said, the main road, I've seen properties which are bang on the main road, very good suburb, very good appeal otherwise, but being on the main road, 6 months, 8 months, the property is still lying on the market, while other properties are just selling within few weeks. Yeah. But this property would stay there for 6 months, 8 months. Then there will be some buyer who will come, and of course, you would have bought it at a lower price, but then exiting also becomes so tough that then you have to let it go. And if your plans are of buying something else, moving there, everything becomes a problem because you're not able to exit easily from that kind of property.
Absolutely, yeah. So investing with an exit in mind also that also brings us to this fact that when I'm investing, I need to know what I'm going to get into and what will happen when I exit. So I can't imagine, I can't think that, okay, I will be there in this property for lifelong there, but I'm going to exit at some point of time, and I understand that risk. But as an investor, definitely risk is something which I have to live with, right? So I would say, okay, I'm taking the risk of uncertainty. I'm taking the risk. That's my mindset. That's my positive mindset, that I carry that uncertainty with me. I know there will be, in a 30-year term of the loan, there will be 10 years where the rates may rise. There will be 10 years where there will be issues, abnormal things, like last 15 years. There's been a COVID, and there's been GFC, and there's so many things which have come in. That uncertainty comes in inherently to me as an investor. So I accept that risk as an investor, that okay, that risk of investment is going to be there, and I accept that there is a risk versus reward in it. But while accepting that these are the ways of investment, as an investor, I know what am I getting into, but I also keep that exit in mind, that if everything goes well, when I want to sell this property, are there only investors which are going to come and buy, or there are going to be investors and owner occupiers both who are going to jump into my property? And hence I enjoy a mathematician and I enjoy an emotional purchaser, and both of them can get me a better price when I want to go out of it, and better wealth creation when I want to go from there.
You're absolutely right, and 100% correct that, see, without any risk, there will be no reward as well, right? So the idea is not to just randomly take some risk, but idea is to do some calculated risk, what your budget, what your capacity allows.
Yeah.
Within that, and what your risk appetite is, within that, take a risk with a of course there will be that kind of reward in mind. And when you're talking about risk, there could be different kind of risk. One is the market risk, right? Like you're saying, there could be events which can happen in the globe, anywhere. There will be wars happening, anything can happen. So you have to accept that as a part of an investment. There will be no investment which will be very, very smooth ride, right? There could be risks at your end also, which some job change, some kind of things, something happens in the family. Those kind of risks are always there, but we live with those risks. The idea is that how do we mitigate those risks? That is the whole idea about, right? There will be a risk. How do we mitigate? How do we manage? And what are we taking that risk for? There has to be an ultimate reward at the end of it. But yes.
Yeah, sure. And it's important, because when we are looking at risk, when we are thinking like an investor, I think it's also important to for us to inherently understand our own self, that as an investor, what do I think, and as an owner occupier, what would somebody else be thinking, and how do I marry these two thoughts? So as an investor, if I would love to put down, so as an investor, for me, my goals are very important.
Yep.
My goals, in the sense that I'm looking at my return on investment, I'm looking at what kind of a cash flow is going to come in, I'm looking at what kind of a capital growth is going to come in. So for me, my goals of achieving that wealth, achieving that cash flow, achieving that capital growth, trying to pay off my mortgage, to have a good plan for me to in the future, whether I want to upgrade my house, whether I want to do something else with it, do holidays, but I have a goal in the end for investment. So as an investor, one of my key mindsets is that I want to have a goal, and I understand that for achieving that goal, there will be various paths I will go through that, and I can form ways of going that, right?
Yeah.
There can be a long-term kind of a way where I say, okay, I'm going to be invested in 10 years, but I also can have a short-term way, right?
Yeah, there are certain ways of investment. So when we look at the objective of the investment, then you define a strategy.
Yeah.
There are pockets where you could actually go and you know that, okay, they are the regional pockets, or they're extremely super regional, but you know that, okay, there are a lot of investors are getting there. Then you need to know your exits.
Yeah.
Few investment properties, you can think about long term. Cash flow is better. You have timed the market properly. You're buying a property in good socioeconomic area where that suburb has already owner-occupier choice. Also, the yields are better. Then you can keep those properties for the longer term.
Yeah.
There are a lot of properties are like rent and flip. So you select those properties.
Yes, short-term investing. Yeah.
Yeah, short term. Yeah. So get those properties, renovate, and flip it, and then make some money. So it depends on the type of goals which you define. Not every investment property is like a long-term kind of investment, but majority when we look for the properties in investment in goal in mind, then it has to be objective-based purchase.
Yeah, correct. No, absolutely. And then there are different, like you're saying, strategy could be whether it's short-term, long-term. Similarly, there are other strategies you can think about as an investor. When you start thinking about, okay, I can have different ownership structure. I can buy in my name, or I can buy in the name of a trust, or I can buy under SMSF, I can buy under company. And for different kind of properties, different structures are better. There are different tax benefits in different structures. You can also think about that, I want to buy, but what kind of loan do I need to take? I start paying principal interest or interest only. This all depends on what your goal is as an investor, what your budget is, what your affordability is, how will you manage the cash flow, and how long do you want to sustain it.
Absolutely right. And you're right. As an investor, I look at all these things. I can look at saying, okay, I want to manage my cash flow, so I'll have an interest-only loan. I want to manage, I want to have tax benefits, so I'm looking at getting 100% equity, and I'm looking at getting maybe I'm looking at making a portfolio. So I say I'm happy to go a higher interest rate, and I can go to a non-bank lender. I'm happy to go to buy under trusts, under SMSFs, under individual name, company structures. A lot of stuff happens there. So as an investor, my mindset is to be able to grow my portfolio, is to be able to find ways that I can invest. But I'm also mindful of what are the taxes which are going to be there. Tax benefits is one bit, but the other bit is the land tax and all those elements which come in. So I am very much aware of that bit as well when I'm looking at how an investor would think. And similarly, there will be a very different way an owner-occupier would think as well, right? So an owner-occupier would think a bit differently from them.
Parameters in the mind of person who is looking to buy a house are very, very different. First thing is like, is this where I want to raise my family?
Yeah.
And it has nothing to do with the capital growth or cash flows or anything. It's more about, is this an area I want my family to grow in? Is this convenient for me? So if I have to go to office every day, I have to drop my kids. Is this going to be convenient location for me? Is this neighborhood safe for me?
Yeah.
Are there good schools for my kids here?
Yeah.
If my family, larger family visits me, is that something lifestyle, right?
Comfort.
So does this allow me? I want to go to city every weekend, and does this allow me to get access to that easily? So there are so many different factors which go in there, and these are completely independent of numbers. Completely independent. Of course, everybody will operate in their own budget, but when I look at the property, I'm thinking, does this give me stability? Emotional, right? My wife will be happy here or not, or over a cup of coffee every day. I'm going to listen from her that why did you buy this property, right? So then I'm not thinking numbers. I want to buy a house where we live happily.
Absolutely right. You need stability, you need lifestyle, you need your comfort of staying there. You need to feel happy when you walk inside the door. You need to really feel nice about it. You need to feel that place is a warm place where you can enjoy with the kids and
Good socioeconomic, good school, concentration of single community, because you need a diverse community also.
Yeah, absolutely right.
Because when you look at the schools or the community related functions, or if you go to the park, then it should be diverse.
Yeah. And you need to have friends around you, family around you. You love to be there, and that's kind of stuff. And then you're willing to pay a premium as well. Unlike an investor who doesn't pay a premium, they want value. But as an owner-occupier, I'm willing to pay a premium for getting all these stuffs. And I normally, when I was talking earlier, so normally I'm more averse from going to the higher interest rate kind of products. I'm averse of going into, I don't want to go to places where I would have to pay extra, or maybe I'll use more of government schemes or 5% schemes. And if I'm a first home buyer, so I'm trying to get maximum benefits I can from there. I'm trying to get stamp duty benefits. I'm trying to get all that bit from this. So as an owner-occupier, my mindset is very, very different from an investor mindset. I'm looking at more things which please my heart rather than only with my mind that, okay, I should make money out of it. I'm looking to look at my heart and say, okay, I love this area. I love to stay here, and I love to be here with my dog, with my family, with my friends, with my neighbors.
100% correct, and that's where the whole, I think it's a science of how do you mix both the mindsets together, and you're able to do a little better, a little better than what you would do without going deeper without thinking about it.
Yeah, absolutely. And I think if you are able to learn from these two mindsets, as an owner-occupier mindset, as an investor mindset, and you are able to invest with an owner-occupied mindset, that's where you create a big win. Because now you know that my asset which I've acquired, my house, my townhouse, my apartment is a winner. Whenever I go out back in the market, I have a winner in my hand because I have got into something which is very good. I have got into an area where owner-occupiers have a demand. right? So if I'm able to, I believe in Sydney. So if I'm going to give an example, there are two suburbs next to each other, and they're just separated by a road. There's a Seven Hills on one side, and there is Bochum Hills on one side, right? The average property price in Seven Hills is very different from the average property price at Bochum Hills, which is much higher. It's much higher because there's a particular school where people will want to study, and they will want their kids to go there, and they would prefer to be there, versus this is a everyday suburb, right? So people would say, okay, I want to go there, I'm willing to pay a premium. So if I'm able to say I want to invest and I've got affordabilities which is similar, so even if it's a house in Seven Hills versus a townhouse in the Bochum Hills, I can, if I choose and do my understanding and I invest in Bochum Hills, I may have a winner in my hand, and which will grow much faster than anything else, right?
Correct. And that plays an important role. Again, as an investor, you're not thinking purely just numbers and buying just anything which is in a suburb which is expected to grow. Yeah.
Exactly, and that's the point, because if your budget allows you to get into a certain suburb, then try to explore more what is available in that price guide, and then look at the properties where, okay, this suburb has only investor outlay, versus in a similar state or different state, if I pick up a suburb where I might have to expand my budget by 40-50 grand, if you can do that, then yes, that suburb has more outlook of owner-occupiers because of the certain parameters which we were discussing. Then try to pick up that property in that suburb, or try to pick up a good pocket of that suburb rather than getting into a purely investor-driven suburb. So outlook of getting a capital growth in a long-term basis will be much higher. For an example, like when you only investing into investor-driven suburb, during the boom cycle, you would expect a good capital growth, but there are historical patterns which shows that when the boom cycle finishes and then investors run out of the market, and if that suburb is entirely populated by investor demand, then long-term growth of that suburb is pretty poor. So, and if you don't time that market properly, then chances of getting a higher capital growth are very, very less. That's why that is very important when you are looking for a suburb or investing into property, mix that angle of owner-occupier demand as well.
Yeah, true. So in that suburb choice between two suburbs to be, that brings us to obviously that thinking like an owner-occupier and saying, okay, I will go into that suburb. Also, if you're within that suburb, thinking like an owner-occupier, you say, okay, there is this school which is near me. The closer I am to the school, I am better off. Versus if my school is, say, 2 kilometers away from my house, I may be in that same suburb, but I may be missing out on what I get as a benefit, because there that school is not allowing, or that distance is kind of negating the benefit which I am deriving from that property in that area, right?
Correct. And there are a lot of other things, like your properties, like we were talking about, main road facing versus park facing.
Yeah.
Let's say the park in front is a small children's park, not too much crowded. So it has a very different appeal for a certain class of people who have young kids.
Yeah.
If your properties, let's say, if on the same street there are 3 properties, similar, and let's say one property is basic and one is a little more upgraded. It's good looking. It is upgraded to the level by, let's say, 50 grand difference. Okay.
Yeah.
But the appeal to someone who wants to live is much higher. So that, although you might be paying 50k extra today, but that may result in an appreciation of extra 100k on that over next 5 years.
Yeah. Yes.
So this kind of comparison, if you're in the same suburb, then what kind of property in that suburb fetches you extra becomes important.
A better landscaping in the front of your house, so it attracts you that, okay, this looks pretty. You go inside, your kitchen is a bit more renovated rather than an investment grade kitchen. That adds value to your house. You have your bathrooms have, either they're just walls or they have tiles which go roof to ceiling ground to ceiling. And if you have this kind of, you have
media rooms, you have better facades, and then the landscaping is better. And there are other examples also, like in the same suburb, you can have 2 different streets and 2 different value. Because when we're investing, for an example, in Quakers Hill, you go towards the north of the Quakers Hill, the socioeconomy is very close to 10.
Yeah, all right.
It comes down towards the west, socioeconomy is 1.
All right, that's that different. Okay.
Another example, Bangarbi
Yeah.
and Dunside.
Yeah. All right.
Bangabi, Dunside shares the boundary.
Yeah.
Bangabi, socioeconomic 10, Dunside is 1. So if you are in middle of the Bangabi, the property prices are extremely higher. But when you're more approaching towards Dune side,
Yeah.
towards the lower socioeconomic area, even though you are still in the Bangabi, but your boundary touches towards the extremely lower socioeconomic area, then property prices will go down.
Yeah.
So where in that suburb, what kind of property you buy in that suburb is very important.
That asset identification is very important.
You need a deep research.
You need deep
You need
research.
a deep research. So it's just not about finding the suburb.
Yeah.
So finding a suburb, it's a huge research because you need to time the market correctly. You need to find out in which cycle you are getting into, what's your budget according to your budget, your cash flow, and then you look at certain parameters. Look at the councils, then suburb. In that
Yeah.
suburb, you see, okay, whether that suburb has the owner-occupier demand or not.
Yeah.
And then you select everything, and when looking at the property, then you have to look at statistical area one, which is the pockets within that suburb.
All right. And when you're saying this, I think it also becomes important to see the forward moving trend of how is the gentrification happening in that area. So
Exactly.
it requires a lot more research. I think that's absolutely right, and that's a negative. Of course, we are talking that yes, keeping that mindset is gives you good returns, but that's a negative of that approach. That's obviously there. That it will take a little more time, more effort, more research from your side. So if you're not ready to invest in your research or in your time, if you're not ready to put that effort, whether you put in yourself or you hire somebody to do it for you, whichever way, but if you're not ready to do that, then of course your investment will be probably average. You always get returns if based on what the effort you're putting in.
Yeah, 100%. Yeah, 100%. You know, so many factors to research on that deep research which you point out. So very important. If you're not willing to invest your time into it, then you are doing an investment with a pure investment approach. You're saying, okay, my math says I'm going to pay $2,000 repayment. I'm going to get a rent of $1,500 and I'm happy with it, or I'm going to get a rent of $2,100. I'm even thrilled with it, and that's it. Then you're not in there. But deep research will bring me a lot of factors to look at, socioeconomic factors to look at, demographic factors to look at. We're looking at how demand and supply moves in that area, infrastructure moves in that area, how things are changing there.
Right price for that suburb also.
All right. Yeah.
Yeah, you can't go to that suburb and then go on a higher side of the pricing.
Yeah.
That segmentation is very important.
Yeah. Yeah. What does that suburb command as a price?
Exactly. So if 50% of the properties are selling at $1 million, and then if only 5% of properties are selling at $2 million,
Yeah.
then if you're buying a property in between 1.8 and $2 million, it's not a right approach also.
Yeah. And that's true, because it becomes important of how do you identify that asset, because if that asset is you've wrongly identified an asset and you are still invested in it, you obviously lose opportunity cost. But that's a different point of time thing altogether. But the more important thing is now you have to do that research to be able to merge these things together.
Yep.
You don't need to go out there and buy an asset or buy a property which is just like that. You're looking at how an owner-occupier looks at it, and an owner-occupier looks at it with a good appeal. If they look at it with an emotional appeal, they think from their heart rather than thinking from their mind, then you are looking at an opportunity which is going to give you a better result when you reach the exit. And obviously there is a pitfall of that, but there are a lot of benefits to this, right? A lot of benefits when you're looking at investing like this, thinking like an owner-occupier to invest into to do an investment, right?
Yeah, so you will have a very high capital growth because as we are talking, if you are investing in a suburb with only an investor mindset, you still get a good performance on your property. But if you're wearing both the hats and buying a property in a suburb where investors as well as owner-occupier appeal, then you'll get outperformance. So your chances of getting a capital growth is much higher
In this mindset.
in this mindset.
Oh, right. Yeah.
I think for me, I think one of the factors which becomes very important is that it reduces my risk. And when I think as an investor, by training itself, I get tuned towards always the risk versus reward. So if I am choosing with this appeal, then because it will have the chances of it having an appeal for people to come in, move in will be there. So the risk of that investment goes down significantly.
Yes.
So that's my mitigation strategy. I would say that's how I mitigate the risk, that if it has more appeal, the demand will be there. Even if there's a lot of supply in that suburb, or if the market is down and property prices are crashing, whatever comes, right?
Yeah.
This property will still have higher chances of moving fast if I want to exit.
Yeah, I'll have a good resale value when I want to sell at the end. I'll always have a great capital growth when I want to sell at
Good
the end.
tenant quality.
Good tenant quality. Yeah,
Tenant quality.
that's correct. Yeah, that's because again, if my house looks pretty, then I'm going to get tenants which are nice, and I can then pick and choose who I want to put in there. So I'm more likely to have a good tenant which comes in there. I can get the better ones versus anybody else on the street, right? And
That's because of good renting affordability. Yeah, because of the affluency, you have good rental income.
Yeah, true.
On the
100%.
property sale, yeah.
True. A good tenant is more likely to give you a higher rental income. So that's a big plus, because then you're marrying both the capital growth and the cash flow in a much better way. And you're managing the risk often. When you want to exit, you will always have a good thing. You're also maximizing your return. You're also having a much better outcome in terms of of what you want to do with investing with an owner-occupied mindset, right?
Correct. That adds a lot of value. That mitigates the risk, and you won't come out of it. I mean, the chance of you coming out of it and thinking about why did I do this, or was it a mistake, or the opportunity cost, I think all of those become much lower if you are able to put in more effort, more time into doing that extra research and wearing that hat. And if for somebody who has actually bought a house for living already, right, for them it's even easier because you've gone through that process. You know what all am I looking at. First time investors, it becomes a little difficult to wear both the hats simultaneously. I would honestly, I mean, that's what I have experienced, or I've seen, that it's not so easy to wear both the hats at the same time. It is a little more challenging.
Yeah.
It requires you to think we talk about this, right? Thinking fast and thinking slow, or the big picture and the small picture at the same time, or long term and short term at the same time. These are a little more difficult, but for people who are able to do it, of course, there's a return.
And because that allows you, right? Then what it does to you is, irrespective of the market situation, irrespective of whatever happens, irrespective of how it moves, you still have a winner in your hand.
Exactly. Yeah, with few examples, like during 2017
Yeah.
till 22, 17 to 18 was Okish market in Sydney. 18 to after 2018-19, we have Royal Commission.
Yeah.
Most of the market was slower. Then you have COVID boom. During COVID boom, most of the suburbs in Sydney become doubled.
Yeah.
Post that, those suburbs which only had investment category, they stopped growing, or the growth was very small. But irrespective of all of this slowness or the affordability peak, if you look at the Ponds or the Kellyville or the Marsden Park, they're still growing because of the owner-occupied demand. So those were invested during that time in 2017-18 in those suburbs as an investor mindset plus the owner-occupied mindset together as an investment property, the growth on their property is much higher.
Yeah.
So that means irrespective of any market cycle timing, you still have a growth.
You still have a growth.
You still have a growth.
And that's true. In fact, when you talk of ponds, I remember in those times, the 16 and 17 and 18s, in those times, there was a market had become a bit slow. And when we used to have clients who would come to us and they would be talking to us about buying a property there, they would go to auctions assuming that the property price is not going to, they can always discount the property price, but never, it didn't happen. That command, because they were always, even in a slow market, I remember those times, maybe open homes would have 2 people coming in, 3 people coming in at best, and there still will be 20 people going into that suburb to want to buy that, because that's an own choice owner-occupied suburb. So an investor who was there was enjoying it, like, okay, whatever is happening, it's good, I am safe, I am secure, and that's because they bought in a place which had that appeal to an owner-occupier. And if your house also, or your property also has even more appeal to an owner-occupier, you got a winner, right?
Yeah, correct. And a lot of times what happens is that sometimes it happens by fluke. I mean, you just happen to buy there as an investor. You didn't. So it's not that every time you thought about both the hats and you made the best deal. But I think, if given that what we know today, right? It's if you're you could have bought just and depended on luck. Okay,
Yeah.
if you are lucky, you will get that delta extra and you will get a winner. But hope is not a strategy. Luck is not the strategy, right? So you have to, if you can strategize, then why not? Why not?
Yeah, absolutely right. No, that's a good talk, gentlemen. I think we've had some phenomenal discussion today, and I think you're right when we are discussing that if we go with a mindset of buying an investment property, and if I'm wanting to invest, and if I also marry that with an owner-occupied mindset, I'm likely to have a great property in my hand, which is going to give me better results, which is going to give me better returns, which is going to give me a higher capital growth in the short term as well.
Yeah, so in investment, just don't look at the performance,
Yeah.
look at outperformance. And you look at it when
Rightly said. Look at outperformance.
you only get it when you are thinking of researching in that result. It's deep research.
Absolutely, and absolutely right. And especially when you're trying to bring in a bit more, you're trying to add a bit more into it. You need research to be able to think like an owner-occupier, but still be an investor, a keen investor with that at as well, right? No, that's fantastic. No, thank you so much, guys. I think it was lovely chat. Thank you so much.
A lovely chat. As always.
Thanks, Julius.
Thank you.
Thanks. Bye.
Bye.
We hope you enjoyed the podcast. If you enjoyed being part of our community today, please take a moment to rate and review the show on your favorite platform.
We don't want conversation to end here. We're all active and ready to chat.
You can connect with each one of us directly via the links below. Thanks for watching. Keep listening. We have a lot of podcasts. Share your thoughts.